And we're back. Our stopping point in chapter, or sorry, in part one, focus on the disadvantages of having a corporation as your type of business structure. We discussed the initial cost, the paper required, the double taxation. When it's saying the two tax returns, again, that means that the corporation files a tax return, and then the individual owners who are the stockholders have to file their own separate tax return. Okay? There can also be conflict between the stockholders, who are the owners, and the board of directors, who makes major decisions for that business structure. Here are some of the largest corporations you're probably familiar with: Walmart, ExxonMobil, Apple, Berkshire Hathaway, the real estate company, and Amazon are some of the largest US based corporations. Okay? Now, there are also what we call private corporations, which means that these companies do not trade their stock on an open stock exchange market, but they do issue stock. However, typically you have to know someone within these organizations in order to acquire stock and become stockholders in these particular companies. Okay? As an individual, yes, you can set up a corporation. So if you're an athlete, a plumber, a doctor, of course, an accountant, you can incorporate your business. Now, most of the time, individuals who incorporate do not issue stock to those outside of the company. So they do not share the advantage and disadvantage of large corporations. Uh, the major advantage are limited liability, because again, as a corporation, you are separate from the actual business, and there could be some tax benefits. For example, the corporate tax rate is a flat rate of 21%, compared to the individual tax rate. You can be taxed as high as 39.6% as an individual. So there are some tax benefits of becoming a corporation. So that was a C corporation. Next, we have what's called an S corporation, which is a unique government creation where it looks like a corporation, but it's taxed like a sole proprietorship or a partnership. So let me explain that to you in a little bit more detail. With an S corporation, the company does file a separate tax return for the business, but then the actual profit or loss of that business corporate stockholders, they receive what's called a Schedule K1, that's a tax form, and then those stockholders will pay taxes on their share of the profit. So with an S corporation, you do have your shareholders, directors, and employees, plus the benefit of limited liability. Because again, as a corporation, even an S corp, the owners are only liable for their investment in the actual business. And again, as I mentioned, profits are taxed only at the personal income of the shareholders. The S corporation as a business does not pay taxes. It's what we call a pass-through entity. Now, for an S corporation, you cannot have more than 100 shareholders. Okay, those shareholders could be individuals or estates who are permanent residents here in the United States of America. If you decide to issue class of stock, you can only have one class of stock. I mean, you can't have common stock and preferred stock, or you can't have common stock class A and common stock class B. And 25% of your, so no more than 25% of your income can come from passive sources such as being a property owner. Okay? Now, if an S corporation loses its S status, it may not operate under it again for at least 5 years. So if you're found in violation, yes, an S corporation can lose their S status, and they're not allowed to use that status again for a 5 year period. Now, the most common type of business structure in 2023 are a limited liability company. They're similar to an S corporation, but without the special eligibility requirement. So more than half of new businesses registrations are LLCs. So with an LLC, the first two L stand for limited liability. So you do have protection. However, the profit or loss that's earned by the LLC is shown on the individual earner's individual tax return. So it's an advantage of the LLC that you do have limited liability. So when it says choice of taxation, what that means is that depending upon whether it's a single member LLC or a multi-member LLC, that will determine the type of tax form required. There are flexible ownership rules, flexible rules when it comes to distribution of profits and losses, and operating flexibility. So with an LLC, it is not as stringent when it comes to a corporation. Disadvantage is there's no stock when you have an LLC. Fewer incentives. So typically with an LLC, there may or may not be stock. Well, there's no stocks. So there's no stock options. There may or may not be a retirement plan. The taxes. The LLC is taxed at the personal income tax rate, which can be higher than the rates of a corporation. And then there's still paperwork that has to be completed in order to set up your LLC. Okay. Next, we have corporate expansion, mergers, and acquisitions. So, a merger is the result when two firms form one company. That's known as a merger. Compared to an acquisition, is when one company purchases the property and obligations of another company. And we'll take a look at some different type of mergers as well as acquisition. When you have a vertical merger, I get an example in a few minutes. That's when you have the joining of two companies in different stages of related business, and we'll talk more about that. With a horizontal merger, it's a joining of two firms in the same industry. So, for example, there used to be the big eight CPA firms, but due to mergers and acquisitions, now we only have the big four CPA firm because some of those firms have joined together in a horizontal merger. So any type of merger must prove to the Federal Trade Commission that the new combined company does not limit the competition unfairly. So although these companies have merged together, the FTC says there still need to be other competitors and that you don't have an unfair advantage on those because of the acquisition. With a conglomerate merger, that's when you have two firms in completely unrelated industries that's joined together. That's known as a conglomerate merger. Okay, so types of merger. If a soft drink company buys a mineral water company, that's a horizontal merger because they're in the same industry. But if a soft drink company purchases artificial sweetener company, that's a vertical merger because they're in different stages in related industry. If the soft drink company buys a snack food company, that's a conglomerate merger because they're in two unrelated industries. So these are different types: horizontal merger, vertical merger, as well as a conglomerate merger. Okay, so let's ask what type of merger joins two firms in completely unrelated industries? ABC. Okay, what's your response? If you said C, C would be the correct response. Fun. In 2019, Disney purchased the Furman TV assets held by 21st Century Fox for more than, look at this, they paid $71 billion. Give them the rights to value properties like The Simpsons. There's Bart. Hey, Bart. So ask yourself, when Disney purchased the rights of 21st Century Fox, was that a vertical merger, horizontal merger, or a conglomerate? Send me your response via email. Other types of expansions. So when take a firm private, this is when management or a group of stockholders take control by obtaining all the firm's stock. So we're saying here that if a company that has issued stock, if the management or a group of stockholders become what we call majority stockholders, then they now can make decisions pertaining to that business organization, because whenever there's a vote and you're a majority stockholder, you have the majority of the stock, then the vote is going to be going your way. An LBO, that's a leveraged buyout. That's an attempt by employees, management, or a group of private investors to buy out the stockholders in the company. So the leveraged buyout. So this happened in St. Louis when InBev bought the actual stock of Anheuser-Busch some years ago. That was known as a leveraged buyout. Okay? So with these type of corporations, they can range in size from $50 million to $34 billion. So they can be a small family business to giant corporations. So business acquisitions are not limited to U.S. buyers. So that means companies from other countries may also buy out a U.S. based business. Okay? A franchise agreement is an agreement whereby someone with a good idea for a business is known as the franchisee, sells the right to use the business name and sell a product or service to others known as the franchisee in a given territory. Okay? So the franchise can be formed as a sole proprietorship, partnership, or a corporation. There are more than 733,000 franchise businesses operating in the United States, creating more than 7.6 million jobs. There are advantages of franchise. So with a franchise, advantages that management and marketing would be assistant. The franchisor provides that management and marketing assistant. Personal ownership, meaning you can buy into the actual franchise. There's a nationally recognized name coming from the actual franchise. Financial advice and assistance could be provided. And there's a low failure rate, meaning that most franchises are going to be successful, but not all of them. Disadvantages, there could be a huge startup cost. You do have to share the profit with the actual franchisor. Management regulations on what you can do. Um, Restrictions on selling by the franchisor, and sometimes there are fraudulent franchises that are taking place. Okay, so I'm going to go to the next slide to show you some of the more well-known franchises. Let me get to that for you. So McDonald's, Dunkin' Donuts, Taco Bell, UPS, Planet Fitness, these are some of the more popular franchises you are aware of. And these franchises, the next slide shows you, they're not just in the United States. So, for example, KFC franchise is not in the US. KFC also is in India. And here it says that although they're known for their chicken, in India, they're more known for their vegetarian and meat options. So you do have to adapt depending upon where the franchise is located. A co-op is a business owned and controlled by the people who use its products. It could be the consumers or the workers with similar needs. So with a co-op, typically they can serve up to 1 billion members, and the members democratically control the business. So the co-op, it is controlled by the members, not by a board of directors. Okay, so that will conclude our chapter 5 video lecture. I hope this will help you to determine what is the best form of business structure for your business. Thank you. Bye bye.